Okay, you guys, as your final exercise this semester in Intermediate Financial Accounting Part 2, we're going to look at exercise 21-23. Now notice they throw in this extra chapter here at the end involving the statement of cash flows. If you'll remember, on the statement of cash flows we had three sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Well, in the operating section we had two choices on which method we could use. They're called the direct method and the indirect method. Now, I'm sure you'll recall the indirect method, where we start with net income and make adjustments to net income to come to net cash flow from operating activities. You're required to show that method on the financial statements or in a schedule attached to the statement of cash flows itself. But most companies on the statement itself will show the direct method and then show that reconciliation of net income to net cash flow from operating activities as a separate schedule below the statement of cash flows. And I don't think we've ever really looked at the direct method. I mentioned that it's can be kind of a pain to come up with some of the numbers that you'll need. But if you look on page 1299, they give us the current year's income statement and some selected accounts from the balance sheets, 2015 and 16 numbers, so comparative balance sheet. And they ask us to prepare the operating activity section of the statement of cash flows for Myriad Products Company using the direct method. Well, we've looked at the indirect method in quite a bit of detail. I thought we'd do the direct here, and we'll kind of let that be a capper for your course, and really for the associates program as well. I hope you guys have enjoyed it. I have very much. I appreciate you being patient with me through the semester and always. And if I can help any of you, please be in touch with me. Now, let's dig into this problem. Now, your textbook, in coming up with these amounts that we're going to need to do the operating section using the direct method, your book goes through some summary journal entries. I know on exercise 21 they ask you to do those to come up with these amounts. I prefer T accounts, and I'm going to show you how to do it here, going through with T accounts. And I think you'll find it fairly simple. So let's start with accounts receivable. Now you have to think about the common transactions that are going to hit these accounts, and we'll talk about them as we go through. They're going to give you every piece to this puzzle except one. And the one missing piece is what we're going to need on that statement of cash flows. So the one heading we're looking for is cash received from customers. Well, cash received from customers, now let's assume this business is making all of their sales on account. And you can assume that on the final as well. Although I'll probably tell you that, they don't here. You can assume all sales were made on account and all purchases were purchased on account. Okay, so what do we know about accounts receivable? Well, they give us the balance at the end of 2015 and the balance at the end of 2016. Now these numbers are in millions, but I'm just going to use them in hundreds for simplicity. So at the end of 2015, on 12/31/15, the balance in accounts receivable was $232. Okay, now you got to ask yourself, when is accounts receivable? What type of transaction causes us to increase accounts receivable? Well, accounts receivable increases when we make sales on account. We debit accounts receivable and credit sales, right? Well, if all their sales are made on account, then sometime during the year 2016, accounts receivable got debited for the amount of sales that happened during the year. Okay? So we can debit accounts receivable would have been debited $660. And that's sales for 2016. I hope that makes sense. We debit accounts receivable when we credited sales, right? So throughout the year, accounts receivable would have been debited for $660 because sales were credited for $660. Okay. We also know the ending balance in accounts receivable at the end of 2016 was $220. And that's 12/31/16. And that's our ending balance, right? Okay, now when does accounts receivable get credited? Well, when we make collections from customers. So here's one of the numbers we're looking for. Cash received from customers. Okay, well, it's going to be, we have these two debits, then this one would be subtracted, right? The credit would be subtracted to come to this debit balance. So I'm going to say, and then we can check these after we put the number in, but 232 plus 660 minus the 220 was 672 million. It would be cash received from customers. Well, does that work out? Let's try it right here. Equals this one plus the debit minus the credit equals $220 on the debit side, right? These two, 892 is larger than 672. So the balance is over here on the debit side, right? So our cash received from customers is one of the amounts that we'll pick up with this direct method statement of cash flows from operating activities, right? Alright, let's just come back. We'll go over to the other tab and put these in after we finish our T account. That's one of the numbers we're looking for. Okay, how about inventory? 12/31/15. Okay, what was the balance? $450. Alright, we don't we're not going to find if all of our purchases were made on account, then we're not going to find that we paid cash to suppliers. We're not going to find that amount by looking at the inventory account, but we're going to need a number from the inventory account to carry forward to accounts payable to get to our number of cash paid to suppliers. Okay? Now, what do we know? Inventory is going to be decreased when goods are sold, right? We debit cost of goods sold and credit inventory. Well, the debit to cost of goods sold for the year from the income statement was $250. Well, we know when cost of goods sold gets debited, inventory is credited. So that's a credit for $250, and that's from cost of goods sold. Okay? When are we going to debit inventory? Well, when we make purchases of inventory on account, right? We don't know that number. We're going to have to figure it out, but we do know the ending balance is $440, right? And that's the 12/31/16 balance. Okay, now what's this number? Our debit to inventory would have been purchases made or purchases during 2016, right? I like saying it this way better. Hang on. 2016 purchases of inventory. And of course that's cost of goods sold for 2016 as well. Alright, how do we get to this number? Well, we have $450 on the debit side. We're going to subtract our credit of $250. That leaves us with $200. So to get to $440, we'd need what? $240 more? So $440? No, that's not going to be it. Let's see. It's going to be $240, right? All right, now let's check it out. We can check it here. Let's add together our two debits. $450 plus the $240 minus the credit for $250. And that gets us $440, which is that ending balance. So our purchases of inventory for 2016, or 2016 purchases of inventory. Let's line that up the same way. I'm sorry, I'm getting caught up in semantics here. Could be, I guess it could always be worse. I love this kind of problem, you guys. I hope you do too. It's just really a numbers puzzle, right? And we're looking for cash coming in or going out from operating the business, of course. Okay, so let's go to accounts payable. Our 12/31/16 balance in accounts payable is not going to be on the debit side. Let me move over here. And that's not supposed to be 16. Okay. Alright, what was our balance in accounts payable? So on the credit side, at the end of 2015, $134. Alright, then the balance at the end of 2016 is $140. Okay, now, what causes accounts payable to increase or decrease? Well, if we make all of our purchases on account, then we're going to increase accounts payable for purchases made on account, right? All right, so purchases of inventory for 2016. Okay, and that number was what, 240? Alright, so what other time, or what other type of transaction, or what's the only type of transaction we normally deal with that causes accounts payable to decrease? Well, it's one of the numbers we're looking for. It's going to be cash paid to suppliers. Okay, well on the credit side, we got 134 plus 240 minus 140. Does that get us there? Alright, let's check it. We've got credits of 134 plus a credit of 240 minus a debit of 234. Yep, that's it. This is the piece that makes the balance come back to 140, right? You'd add your two credits. I can do it again here. Add the two credits. Credit balance and the credit for purchases. Subtract the debit, which was cash paid to suppliers, and it gets you back to that ending balance of 140. So here's our second number. I'm going to put all these in bold. Cash paid to suppliers. Now, we didn't need one from inventory, but notice how we had to have this piece from inventory to fill out the accounts payable to account. Alright, let's keep moving. On salaries payable, we're going to get cash paid to employees. Well, let's first look for the salaries payable balance. Like accounts payable, it's going to be a credit balance. $86 at the end of 2015. Okay, and then you can kind of fill these in as you want, but we know the balance at 12/31/16 is going to be $80. See what's happening here, you guys? They give you every piece of the T account but one, and you have to figure out that one piece. Well, what increases salaries payable? Well, what increases salaries due to employees would be salary expense. Now, let's say they set up salaries payable every time they pay their employees. Most companies would not do that, but all of the salaries expense could, at least conceivably, run through this account, right? So salaries payable would be increased for salaries expense for 2016. You debit salaries expense, credit salaries payable, right? Okay, salaries expense for 2016 was $110 million. Okay, now what's going to decrease salaries payable? Well, when we actually pay our employees, or when Myriad Products actually pays their employees. Well, what's it going to take to get there? We got 196 on the credit side. That's 196 minus the $80 ending balance that did not get paid. Tells us we must have cash paid to employees of $116 million, I believe, or is it in thousands? No, it says in millions. And let's make sure that makes it work here. You got your 86 on the credit side, plus the credit of 110, minus the debit for 116, and that gets you back to the $80 balance. Not really necessary, you guys. I just like to check them each time. Certainly can't hurt. Okay. Then let's take care. We're looking for cash paid for interest. We'll start with interest payable. The interest payable balance at the end of 2015 is $20, or $20 million. The interest payable balance at the end of 2016 is $25 million. Okay, what increases interest payable? Well, every time if we debit it, like on salaries payable, you just kind of have to play along. The expense could be run through the payable account, right? Let's assume that it is. Okay, so when interest expense was debited, let's assume interest payable was credited. So we're going to credit interest payable for interest expense for 2016. All right, the interest expense was 20. So over here, we're going to get cash paid for interest. Okay, well, it's going to be equal to 20 plus the 20 is 40, minus the 25 that did not get paid, equals what, 15? And you can tell that works. You got 40 on the credit side, minus the $15 debit, $15 million debit, gets us to $25 million. And there's another one of your numbers you'll need on your direct method statement of cash flows, cash paid for interest. Now on income taxes, Well, our 12/31/15 balance is going to be on the credit side here, 10 million. We're going to end with a credit balance of 15 million on 12/31/16. Well, what affects the income taxes payable account? Well, income taxes payable would be credited when income tax expense was debited. Now here we don't have a deferred tax asset or liability to deal with. If we did, that would change things up a little bit. What we're going to assume here, though, is when we debited income tax expense, we credited income tax payable. So this is income tax expense for 2016. Okay. The income tax expense was 91 million. It sure would be nice, right? That means you've had a good year if you're paying 91 million in income taxes. It'd be fantastic. You might be thinking it'd be terrible to pay the government that much. Well, if you're paying them that much, you've made way more than that yourself, right? It's been a good year. So let's say cash paid for income taxes is going to be this other missing piece of the puzzle, if you will. Okay, so we've got the $10 credit plus the $91 credit minus the 15 in income tax payable that didn't get paid this year. Leaves us with 86 cash paid for income taxes, or 86 million. Now let's make sure that works. I don't believe it will. You got 101 million, the 10 plus the 91 minus the 15 that did not get paid. Yes, 86. Okay, you guys, we're going to bring these bolded numbers now. This 1, 2, 3, 4, and 5. We're going to bring these bolded numbers along with the heading that I have with them here to our other tab, and that'll be our cash flows from operating activities completed using the direct method. Okay, and what you really got to remember here, what changes accounts receivable? Well, it's increased for sales, decreased for cash received from customers. What changes inventory? Well, it's decreased by cost of goods sold, increased by purchases of inventory. What happens to accounts payable? Well, it's increased by purchases of inventory, decreased by cash paid to suppliers. What's going on with salaries payable? Well, it's increased by salary expense during the year. What's due to employees is increased by salary expense for the year. It's decreased by what we actually paid them. Interest payable would be increased by interest expense due for the year, or incurred for the year. It would be decreased by cash actually paid for interest that year. Income taxes payable would be increased by income tax expense for that year and decreased by cash paid for income taxes that year. Okay? I think this is a really good wrap-up one, and it, you know, it speaks to your knowledge of what affects these accounts. The rest of it's really simple, and we'll wrap it up in the next video. Thanks, y'all.